Hey there and good afternoon traders. This is Trader Tim from over at eminimind.com doing a Monday market analysis video for the 11th of May 2020. I wanted to start today's E-mini S&P and walkthrough with looking at all of the unfilled gaps, and you can really see them starting to mount up here. This is just a daily chart, and every one of these horizontal lines is a close that has not been touched again. You can see, with the exception of today's, or the gap that we filled today from here on the 30th. And I left that just because I wanted to highlight when we open up and move and fill a gap. In this case, we gapped down. We touched this gap, and then so it was then filled. That oftentimes leads to a reversal. So then we can delete that gap. Now, with so many gaps mounting, it's very likely that we're going to get some kind of bigger move coming. Regardless if it's up or down, we should see some, with this last couple of weeks, there's been pressure building up. So we should see some sort of resolve here in the next 2 weeks or so is what I'm looking at. We've been in this awkward gapping tight range now for almost 3 weeks. And so, if we go back all the way even to the really the beginning of April, we can call it a month of this kind of gap up, small range, gap down, small range, gap up, small range. So all of these days having pretty small ranges, meaning just the high and the low of the day. We had this one day in here that had a 60-point range, but the volatility has just completely shrunk or retracted and worked its way all the way down to 27 here is our current VIX, and we were seeing VIX 70, 80, so the volatility has come down a ton, but I think that we've got some pretty big moves on the horizon. If we go to the extension that we're sitting in, its target up here above us is 30.23, and that would be the second extension long that would have traded. The first one was back here, traded up to its target, and so then I just took that anchor point and moved it up to the next high. It's not too common to have like 3 or 4 of those in a row where you go like to the new high. So we have this high here, then the next one, trade the target, and then we'll go to the next one, trade the target. Those types of moves, when they do occur, where you have multiple, 3, 4 extension anchors trading, tend to do something like this, where you are extended for so long that we end up with a bigger pullback. And we could certainly move higher here because we're beyond the negative 61.8 of the short, but with so much potential for downside here, in large part because we do have so many unfilled gaps below us as well as above us. But the ones above us are typically pretty easy to fill just because the market traditionally goes higher and it will make new highs, whether it's a year from now or 5 years from now. The gaps that are above us will get filled, but it's the gaps that are below us that can really kind of fill in rapid succession. We have a couple of big body candles to the downside, and it's just boom, 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 and we fill 5 or 6 unfilled gaps in like 2 days. So that's kind of that curveball that I'm just keeping in the back of my mind here because the volatility is so low. I don't want to get caught off guard if we go into a week or 2 or 3 days of some bigger body, kind of a little bit more panic selling days. So what does that mean from an intraday perspective? Well, if we go over to the 5-minute, if the retracements that you're drawing intraday on, like, say, the 5-minute chart or the 15-minute chart, either one, if you look at that distance between the 50 and the 61.8, right now we're looking at, halfway backs for the day that might be 4 or 5 points between the 50 and the 61.8. This one, about by the time you account for putting your order ahead of the 50 and below the 61.8, you're looking at about 3 points. So when you start to see those drawings get bigger, like the distance between the 50 and the 61.8 get really big, then you really want to make sure you're taking setups on the 512 tick chart. But when volatility is smaller, a setup like this drawn on the left chart, on the 5-minute chart, is going to be pretty visible on the 512. If I just look at Friday, and we look at that same time period. Actually, I wanted to go down even smaller. This first long is visible on a 5-minute. You've got 4 bars that encompassed the anchor points low on the first bar, and then the second bar, the third bar, and then the anchor points high is the 4th bar. Well, that same drawing is totally visible over here on the 512. So it's okay to take a setup like this on the 5-minute chart or a 15-minute chart, because you could also draw it on the 512 and see that retracement pulling back, and the distance between the 50 and the 61, it's only about 2 points. So it's not very big. If you wanted to wait for the setup to see if there's some support, then you could take the next setup after what I'm calling this one here being the larger 15-minute or 5-minute setup. You can wait and take the 512 after that. Where that becomes super critical is when the volatility becomes high, when the distance between the 50 and the 61.8 really stretches out. Then, in order to put your stop below the 61.8 on a 15-minute chart or a 5-minute chart, you're going to have a 10-point stop. It's going to not really be quite realistic to be able to stay in that trade for 40 points without having your stop 20 or 30 points away from where price is. So when volatility is small, you can trade right off the 5-minute chart. If you want to see a little more confirmation, let it trade and then draw up the very first setup on the 512 following that 5-minute draw that you made. But the goal is to still get to that 5-minute target. So if this is the drawing and this is the negative 23 on the 5-minute, look at where the negative 23 is on the 512. It's not going to be as high, but we trade beyond it pretty quickly to that negative 23. So if you can get to multiple contracts, or trade using the micro ES so that you can have multiple contracts so that you can get those runners to the larger targets, then you're going to have a much better chance of success, because you need those bigger winners. You can't just risk 2 points and take 2-point profits, and even with like a 60 or 70% win rate, it's going to be hard to really gain momentum. So you need those bigger winners, those 3 or 4 times your risk occasional winners that are not super hard to get. So that's the good thing. It's not like those are knocking out of the park home runs. Another thing I want to mention today is so there haven't been a lot of day trades in the last week. I think I had 4 trades last week, pretty light on the ES, and we've been getting a lot of this garbage at the open, where the first 30-minute range, so this would be the 30-minute range low, I'm just going to not mark that, but the 30-minute range high up here is totally acting as resistance. We're completely inside the range. Today we made a very compelling up trend line here, so kind of an ascending triangle, knocking our head on the top of this range. But by the time we broke out, we're 2 hours into the day, and then the market's finally on its way, sort of making its move higher. So there was one little counter trend short this morning, high tick at highs, about half hour, 36 minutes into the day, where we had a high tick that lined up with highs, came down, broke the swing low, set up at 29. You could use 2900s. If you round down, this one was 2907. I'm sorry, you could use 2907 as your entry. This one being 2907.49. If you wanted to call that 50, then you could just round down and make it 2907 and a quarter. Not super critical on the rounding. The idea is just to get your order a little bit in front of that 50%, and then the 2-point stop is going to just keep you in the trade. You could still use a 3-point stop if you want, but with the volatility coming down, I've kind of reduced that a little bit. But we weren't able to make it to the bottom of the first 30-minute range. You can see here on the 5-minute, the higher lows taking us up all morning. So when I see a high ticket highs and hard resistance at the top of the first 30-minute range, I'm thinking, okay, let's see if we can get to the bottom of the first 30-minute range. And when we can't, by the time we get going, we kind of trade through the 61.8, trade through it again, finally come down and break the swing low, trade through the negative 23, through the negative 61.8, getting momentum, and then reverse and don't even come down to lows of the day. Now it's time to really be careful on the shorts, because you're building up this, these series of higher lows, and then from this point on, we really didn't get a high tick that lined up with highs here in the morning. These high prices just continued on without lining up with high ticks. So that was the morning today. Another kind of, when you're in it, when you're in it like this, man, is that a mess, and is that super hard to trade. So be careful when the day starts like this. Sometimes it's worth just sitting on your hands and waiting till a little bit later in the morning, or just looking for high ticks or low ticks to take some fades and call it good and go to the next day, because otherwise you can really get chopped up and start your week off on a really sour note. The last thing I wanted to touch on are the swing trades, and I'll just run through. I got 5 going. So Abbott is the long from down here, above the high of the low bar, working its way up kind of every day, making a higher low, and so that's where I'm putting my stop, trailing below each prior day's low. And then the next one is CIEN, also trading from the same day that ABT did. Now this one broke a little bit, and I took some off when we broke the low of the 5th. And then, so I got half the position on, and it's continued up, and a nice uptrend here in the last couple of months. And then I got 3 shorts going. KO is the first one. I've pulled out 2 chunks out of this one. So I was short below the low of the high bar. We sold off. We broke above this day's high, and we had moved beyond, I think this one we moved beyond the first 15-minute bars high, so I closed out there, and then I closed out half there, and I put another half for the stop above this day's high, and we actually broke that by just a couple of cents, and so I ended up getting taken out of the other half, so I'm down to about a quarter on that one. But then the other couple, VSATs, looking good. This one had gapped up here, and but it didn't take out the swing high here, and so looking good on the short there. And then the last one is WBA, and then same thing. It broke this day's high on the 4th, but it never broke the first 15-minute candle's high, and so we talked about this a few weeks ago. And so on this morning we gapped up, and instead of leaving my, instead of starting the day putting my stop above the prior day's high, I just move it to above the first 15-minute candles high, and then all the way down. We never broke that high, so you stay in the trade. It's worth giving it a little bit more wiggle room to stay in the trade and see it. It's already a positive trade. I'm already in the black here, so just giving a little bit of wiggle room on the profits to see if it rolls over and goes down another, $3, $4, $5. It does tend to help you stay in some of those trades longer without, with more shares. I'll typically scale out in like halves or quarters with the swing trades when I'm trading the underlying stock, but the idea again is still to keep as many shares on as you can, because you don't want to have the trade move $20 and out of your 1,000 shares you've only got 10 left. Because your risk reward on the whole position will end up being a little bit skewed. So that's what I got for you today. Tomorrow we'll be doing a live trading session over at eminimind.com/VIP, and you can tune in there. If you have questions, leave them in the comments below. Thanks, and have a great week.